Hello everyone, how are you all? I hope I am visible and audible as well. Please confirm once whether I am visible and audible. Let me check by my end as well. I think it's absolutely fine. Please once confirm that everything is fine. I am audible and visible as well. And how are you all? Please mention in the live chat section. This is a live session. So I just want your interaction to make this chapter more easy and comfortable at your end as well. Okay. So just hi Ravi. How are you? I just want all your attention today and all your presence in the live chat section. So everyone who are not available in the right section, in the chat section, please be available. Ravi, the voice is slow. I think it will be clear. It will be fine when I'll start speaking and teaching. I hope it is fine as of now. Hi, sir, Kalai. Hi, Kalai. How are you? Is everything fine? I hope you have studied the previous two or three chapters that we have taken in this DT exemption series. The schedule that we have shared, that we have already completed the taxation on the dissolution and the reconstitution of the firm. We have completed the DTAA and its question as well. We have completed the MET concepts. Now we are starting with the non-resident taxation. As I have already said, the MET question and answers will be done after the PGBP. As in few of the questions of MET, the implication of PGBP will be there. So the MET questions will be done after the PGBP chapter concepts and the question and answers. Is this clear? Uh, Hi, Sekar. Is everything clear? Have you all watched the previous lectures? Just let me know. Have you all watched the previous lecture? Then we'll start our session today. Or how many of you are new today? Like this is the first session in the DT exemption series or on this channel. Ravi Krishna has already saw the previous lectures. Okay, good. Now we are starting with the non-resident taxation. Today our topic will be the non-resident taxation. The non-resident taxation is a very easy topic. You just need to understand the full logic behind the chapter and the full logic behind the every provision that came in this provision. Okay, yes sir. First of all, I want to thank you. Thank you, Sekar. Okay, just come on to the applicability of the chapter. First, we are coming to the applicability of the chapter. To whom the chapter will apply? See, first of all, we need to understand who is the non-resident. On those only the non-resident taxation will apply. So, to understand the non-resident, there is a section number 6. Okay, if the section 6 applies to you, the conditions under section 6 is fulfilled by you, then we have to check whether the income earned by you is deemed to accrue or arise in India or not. If that income is deemed to accrue or arise in India, then the taxability is set on you, that you have to you have to give tax in India. O- Okay, now you have to give tax in India. So at what rate? Then section 115A and section 195 came into picture. Now today our target is this box. Section 115A plus 195. The residential status we have already studied in the intermediate examinations. We will do in this series as well, but after 2 days. First, we'll complete today this point. Okay, we'll complete this portion as well. We will complete this portion as well, and we will complete this portion as well. After that, few exemption section will be done tomorrow, and after that, these points, the non-resident residential status and the income deemed to accrue or arise in India, will be done in this series. Is this okay to you all? Is this clear? Okay, clear. Great. So come on to the point where we have written the 115A section. If you have not taken the printout of these notes, the notes are available on my Telegram channel. The link of the Telegram channel and the group, the WhatsApp channel, which you all can join, is given in the description box. So you can join from there. Now, come on to this page. Tax on interest, royalty, fees for technical services. This is the most technical point which students used to think that this is the most technical point of this chapter. But we'll complete this very easily. Is this clear to you all? Clear. Okay, understand this. Tax on interest, royalty, fees for technical services in case of a non-resident. Now, as per Income Tax Act, the income tax will be applicable on the income earned by a resident or a non-resident. Is this point clear to you? Now, the resident income we have already studied in the various sections of the income tax. Now we are specifically studying for the non-resident. Okay. First point, foreign company or other non-resident. First point is applicable to the assessee who is a foreign company or other non-resident, means any non-resident. This is applicable to any type of non-resident. Okay. Now, what is the first type of income covered? Income covered is dividend. Here the word is written dividend. Dividend written means it is actual dividend received or deemed dividend received. It may be deemed, which you have studied under section 222A to 222E of the Income Tax Act under the chapter income from other sources. It is actual or deemed dividend. If the non-resident earn the dividend income from a company which is located in a IFSC. What is a IFSC? I have already told you in the previous lectures. So if a non-resident earned the dividend income from a unit situated in IFSC, then the government want to tax it at 10% only, because the government want to give the tax relief to the entities which are situated in the IFSC. The government want to promote IFSC sectors. So the government want to tax at the lower rate so that more people can come into the IFSCs. Okay, so the dividend income which are earned by the non-resident, if that dividend income is earned from a company which is situated, which is located in IFSC, then 10% applicable rate will be applicable. How it is concessional? How it is concessional? Because we talked that the non-resident are the need of the government. The government want that more or more non-resident came to India and they invest in India so that we can develop on that money. We will have the dollars, we will get the euros, we will get the dirham, and we will get any sort of currencies. So our forex reserve will increase. By increasing forex reserves, our currency will appreciate. Our currency will The value of our currency will go up. So from a unit in IFSC, government want to give the tax rate, concessional tax rate at the rate of 10%. And for from others, other than the unit located in IFSC, the tax rate is 20%. So these are the two tax rates for the dividends. First tax rate is the rate where the non-resident earn the dividend income from a unit located in IFSC. The 10% rate is applicable. For other than from earning dividend other than the companies located in IFSC, the tax rate will be 20%. Okay. Now coming on to the next portion, interest portion. Interest from government or Indian company on money borrowed in foreign currency. Suppose what is happening here, the government or the Indian company, Indian concern is an Indian company. Okay. So the government or Indian company borrow some money from the non-resident in the foreign currency. Okay. What is happening here? The government of India or the Indian concern is borrowing some money from the foreign company or any other non-resident. Okay. On that borrowed money, the government or the non or the Indian concern is paying what? Interest. So the interest received by the foreign company on what the interest is earned on the money borrowed in foreign currency. The money which is borrowed by the government or the Indian concern will be in the foreign currency. Then only this point will be applicable. So the applicable rate will be 20% only. Okay. How it is concessional? I just want to know. I just want to tell you that for a foreign company. What is the applicable tax rate? If you know, can anyone tell me in the chat section? What is the applicable tax rate, the normal tax rate for the foreign company? The normal tax rate for the foreign company is, I'm waiting for your replies. 40%. Okay, great. So the normal rate of tax is 40% for the foreign companies. Now, what we are charging here? We are charging here only 10% or 20%. So this is the concessional rate that we have given to the non-resident to attract more non-resident in India so that we can earn in dollars. The government will get dollars from this. Okay, so for that perspective, government wants to motivate, government want to incentivize the non-resident to come in India and invest in India so that the Indian concerns can earn from that. Okay, now on the same line, now what are the type of companies which are borrowing money from the non-resident? Now, the interest received from infrastructure debt fund. These are the debt funds which are basically for the infrastructure. Okay, like the government used to, if you remember, if you know, there is a company like L&T. Okay, it is engaged in the infrastructure business. So if a company engaged in the infrastructure business and they want some debt, they want some loan, or they want some capital to build their capital so that they can invest in any business. So for that purpose, they might need some loan, they might need some debt fund from the companies. So the government said, if you borrow if you borrow investment debt fund from a foreign company or other non-resident, then when you pay the interest to those non-resident, the non-resident of the foreign company will be taxed at the rate of 5% only. So, in other sense, what I mean to say is, when a foreign company invests in any infrastructure debt fund which is notified by the government, like the L&T is notified by the government. Okay, in the practical world as well, the L&T is notified by the government. So, the foreign companies, when they invest in the infrastructure debt fund, so the interest received by the foreign companies will only be taxed at the rate of 5%, not the normal tax rate at the rate of 40%. Is this clear? But now here as well, the government is not sure whether the non-resident will give the money or not, will give the tax amount or not. So the government comes with a provision of TDS and said to the L&T, when you pay such interest to the non-resident company or other non-resident, ensure you have deducted the TDS at under section 194 LB at the rate of 5% only. Is this clear? So the government want to ensure its tax revenue. So the government just incorporated another section of the TDS so that they can get their revenue. They can get their revenue surely. The non-resident is the person who will not come back in India and file the return. So the government already takes the tax on the said income by way of TDS sections. Is this clear to you all? Please keep on replying so that I can know where you are understanding and where you are not understanding, so I can explain it in more detail. Okay, so is this clear till now? Now, moving forward, interest received from Indian company or business trust on money borrowed from source outside India. Okay, now what is happening? The company is Indian company or the business trust. They are borrowing money from a source outside India, means from a non-resident. The Indian company and the business trust are borrowing money from a source outside India, means from a non-resident. In what manner? In foreign currency. Foreign currencies, the ways are two: through loans in foreign currency or by way of issue of long term bonds in foreign currency. The company may source, the Indian company or the business trust may source the money borrowed by two ways, in the foreign currency or through rupee denominated bond, either in the foreign currency or in the rupee denominated bond. But in the foreign currency there are two ways. First way is through loan, you can raise fund, or another one is the long term bond. But now some can raise the doubt, sir, whether why there is not equity. We can raise money from the equity as well. The company can issue their equity, and the people, the non-resident people, will subscribe it, and we'll get the uh, fund that we needed, like the GDRs. Why don't we issue that GDRs? Why here not equity? Why only the loan and the long-term bonds are only available here? Because on equity you pay dividends, and the dividends you are already covered in the first point. This point is for the interest received, and the interest is paid only on the bond or the debt structure of finance. Is this clear to you all? Is this clear? Okay. Now, for that, these type of interest received by the by the foreign company or the other non-resident, the tax rate will be only 5%. Is this clear? The tax rate will be only 5%. Now, interest received, I am audible now? Okay. Interest received. Now everything will be same. Everything will be same, but here only one addition will be done. See, you will find everything same. Interest received from Indian company, business trust on money borrowed from a source outside India, approved by CG. Here also approved by CG up to 30th June 2023. Here also up to 30th June 2023, in foreign currency by way of issue of long term bonds through rupee denominated bonds. Everything is same as we have already studied in the part 1. The same here. Then what is the need of putting this another section? The government is saying everything is same, but the companies, the Indian company or the business trust who borrowed money shall be listed on the recognized stock exchange located in any IFSC. Like in IFSC, IFSC is in the Gujarat Gandhinagar. So if any company which is if any recognized stock exchange is available on the IFSC situation, and the company, my company, is listed on the RSE of that IFSC, so the recognized stock exchange of that IFSC, so the Indian company, when they will pay the interest, the government will take the tax at the rate of 4% only. The government will going to take the tax at the rate of 4% only. Is this point clear? Because why from 5 to 4? Because here it is IFSC, and we want to promote IFSCs. Is this point clear? Now, coming on to the third point. This is your Finance Act 2023 amendment, which is applicable for your examination. So listen to it very, very carefully. Okay. Now, again, everything is same. Now, government said, here we have covered the interest received up to 30th June 2023. Suppose where a company earned the where a foreign company earned the dividend, the interest income after 30th June 2023, so they will get at the rate they will get tax at the rate of 40%. From 4 they get at the rate of 40%. This will be a injustice to those type of companies which will get interest just after a day. So the government said same thing. The interest received from Indian company or business trust on money borrowed approved by CJ from a source outside India on or after 1st July 2023. Here what it comes, on or after 1st July 2023, in foreign currency by way of issue of by issue of any long term bonds or through rupee denominated bonds. Again, is listed only on recognized stock exchange located in an IFSC. So now what the government says, government clubbed this provision plus this provision. The first part of interest, the second part of interest, they clubbed and come with the third part of interest. So now the what is the tax rate? 5% plus 4% is equal to 9%. This is just a way to remember the tax rate, nothing else. Is this clear? We have clubbed both the provisions. The first provision of the interest where there is no recognized exchange. Now we have come with another point where we added the recognized exchange plus the interest that is the normal provision. So here we come up with the tax rate of 9%. Is this point clear? And the TDS rate will be at the rate of under the section 194C for all type of interest, for interest part 1, interest part 2, and interest part 3. For all these three sections, the TDS section will be applicable 194 LC, and tax will be deducted at the rate of 5% under section under this part, at the rate of 4% under section this part, and at the rate of 9% if it fulfills the conditions given in the third part of the interest. Is this point clear to you all? Please write it down in the comment section that I can understand whether it is clear or I should move forward. Is this clear? Clear. Okay. Here our assessee was foreign company or other non-resident. Now here our assessee changes. Now our assessee is foreign institutional investor and the qualified foreign investors. In short, it is said QFI. FII and QFI. These are the type of people which are uh, heavily net worth, which are heavy in net worth. They are very rich type of peoples. Okay, they can be a companies, they can be a very rich type of companies. Okay, so from the government securities, if the FIIs and the QFIs getting the interest income up to 30th June 2023 from the government securities, the FII and the QFI are getting the interest income up to 30th June 2023, the interest income in respect of and again this is for the central government. Okay, now for the state government, if the state government issued any municipal debt bonds, if the state government issued any municipal debt bonds and any FII and QFI subscribe to those bonds and they are getting interest from those bonds, these municipal bonds are in the practical world known as the muni bonds. So if the FII or the QFI is earning the interest income from the municipal bond when these bonds are purchased on or after 1st 4th 2020 but up to 30th June 2023, these will income will be taxed at the rate of 5% only. Is this point clear? Now coming on to the next point, the non-resident unit holder. Now the word comes here, the unit holder. The unit holder itself signifies that there is something related to the mutual fund, unit trust of India, or maybe the business trust. In these chapters only we have used the word the unit. The unit are only issued by the mutual fund companies, unit trust of India's, or the business trusts as well. So in these case only the units are applicable. So here as well only these type of incomes are covered. If a non-resident unit holder are earning any type of income on units purchased in the foreign currency of a mutual fund or UTI in India, these companies should be in India, but they should purchase it in foreign currency. So any income which they will earn from India, any income, here the word is income. Above we have used everywhere the word interest or dividend, but here only we are using the word income. So here every type of income is covered, whether it is interest income, dividend income, capital gain income, any type of any sort of income will be covered under this point. So non-resident unit holder will be covered under income on units purchased in foreign currency of a mutual fund or a unit trust of India. Is this clear? This will be taxed at the rate of 20%, and taxed at the rate of 20%, the TDS section is 196A, under which the TDS will be deducted at the rate of 20% only, the same rate. Is this point clear? Now coming on to the last point of 115A. What 115A says? For that, I just need to make you understand one provision. Suppose it is a SPV. special purpose vehicle. They issued the unit to a business trust. Now, business trust is not earning anything. This is just an entity to pass on the smaller units of. um, Suppose the SPV issued 10,000 units to business trust. Now, what business trust do? It will convert this into 10 lakh units. Suppose, and sell it to investors. Various type of investors. Now, here can be a non-resident investor as well, who have purchased these type of bonds, these type of units of that SPV, the special purpose vehicle. We have studied this in the business trust chapter. Okay. So when the income, now suppose the SPV have give the interest income to the businesses, because the SPV issued the units to the businesses, so they have issued the interest to them. Now, what business trust did? Business trust proportionately shift the interest to the non-resident. Okay, whatever proportion is made for the non-resident of these 10 lakh units, the proportionate amount of interest will be passed on to the non-resident. So here the government said the proportionate share, like in the proportionate share, suppose here the dividend interest income comes rupees 5,000. Okay, so the proportionate share of interest from SPV out of distributed income by the business trust, from SPV by the distributed income of business trust. Is this point clear? This will be taxed at the rate of 5%, and the TDS will be deducted at the rate at under section 194 LBA. See, special purpose vehicle is a tough name. Okay, so LBA, the section should also sound like a tough section. So, and it has three letters. It has three letters. So this is the just only way to remember. So you can remember if you like this. Otherwise, you can ignore as well. Okay, then here 194 LB, 194 LC, 194 LD. This is the sequential letters, so you can remember as well. Then at the last, residual is 196A. This is the whole provision of 115A, where you have remembered the tax rates as well. Is this point clear? Is everything clear till now? Shall we move forward? Now, coming on to the additional provisions. The government said, we have given you the concessional tax rate of 10%, 20%, 5%, 4%, 9%. So we are not going to give you the deduction. No further deduction under the head PGBP or IFOS shall be allowed to you. No further deduction under chapter PGBP or IFOS shall be allowed to any type of non-resident if they are giving tax under section 115A. Here it is written PGBP or IFOS. The unabsorbed depreciation will not be available, because it comes under section 32, which comes under the PGBP section. So the unabsorbed depreciation will not be available. So whether the set off provision and the carry forward provision will be available, yes, that will be available, because it comes under section 70 series, the 72 or the 74 and onwards. So when it neither comes in PGBP, neither comes in IFOS, so the set of provisions will carry on as usual. So here it is given the chapter 6A, chapter 6, the provision of relating to the set off of losses shall apply as usual. It's implied here that unabsorbed depreciation can't be set off, as it is covered under section 32, which falls in for 28 to 44C. Is this point clear? Now coming on to the point that no need to file ROI under section 139 when a non-resident is earning income from these sources only. Only word I am using, only word. When a non-resident is earning income from these sources only, which are specified under section 115A that we have just studied, then and on those income as well, the TDS at the respective rate under the respective section has been deducted. Then the government simplified the provision and said there is no need to file the return of income for those type of people who have earned only those income which are specified under section 115A, and the TDS has already been deducted at the rate specified in the respective sections. Is this point clear? If total income includes only these income and TDS has been deducted at the rate specified, then there is no need to file ROI. Is this point clear now? No deduction under section 80C to 80U against such interest or dividend income. No type of section 6A chapter 6A will be available except 80LA, which is for IFSC companies. So only 80LA deduction will be available because we just want to promote IFSCs. So the government here also give the benefit to the IFSCs, and apart from that, all the section of chapter 6A is not deductible under this provision of section 115A. Is this point clear? I hope. Now, the tax shall be deducted at the same rate specified under section 115A, that I have already told you that the under section 194 6 194 LC, the TDS will be deducted at the rate of 5%, 4%, and the 9% respectively. This is the whole provision of section 115A. I hope it is clear to you all. Is it clear? Now, coming on to the two question points. See, As per as per 1015, interest payable to non-resident or a foreign company by a unit in IFSC on money borrowed by it on or after 1st September 2019 is completely exempt from tax. Here what is written? The unit in IFSC. When a unit in IFSC, just a second. When there is a unit in IFSC, and from that the NR and the non-resident NR or the foreign company is earning the interest income and on the money borrowed on or after 1st September 2019, then the whole interest income will be exempt. Now there will be a confusion that on or after 1/9/2019 it is exempt from tax. Then why are you taking the tax at the rate of 4% and 9% here? It is also earned from a company listed in IFSC. It is also earned from a company listed in RSE. Then why it is exempt here and we have taken tax 4 and 9% here? Is there any problem in the law? No, there is no problem because what is written in the law, just notice it once. The law is very clear. Law say is listed on a recognized stock exchange located in any IFSC. It should be listed. The company should be listed. But here what is said? The company should be in IFSC. Like the company should operate in IFSC, then section 1015 shall applicable. But if the company is not listed in not located in IFSC, but just listed in the recognized stock exchange that is available on the IFSC, then the rate shall be 4% or the 9% respectively as per the sections, as per the rate of interest income earned. Is this point clear to you all? That the caution point number one. Now coming on to the point number two. As per 10(4)(c), interest on rupee denominated bond issued by Indian company or business trust during the period 17/9/18 to 31st March 2019 is completely exempt from tax. That where a interest income is earned from a rupee denominated bond issued by a Indian company, when an Indian company issued a rupee denominated bond to a non-resident, okay, from the period between 17/9/18 to 31st March 2019, then it is completely exempt from tax. This provision is not so very important to learn. It is just, I just want to let you know this point as well because this is available in your study material. So I just not want to leave any part of that. So just I made you understand this point, but it is not at all applicable. It is not at all important for an exams. Is this clear? We have completed the 115A section. Now we are completing. Now here I have also given the same thing, the question that we have already discussed. Don't confuse in the provisions of section 115A and the section 1015. 115A talks about the interest paid by the Indian concern or the business trust. It should be listed in the IFSC, whereas the section 1015 talks about the unit located in IFSC. Both are the different. Both are different. Is this clear? Now, tax treatment on royalty and fees for technical services received from government or Indian concern in pursuance of the approved arrangement. Here, what it comes, royalty and the FTS. Above what we have studied, above we have studied the interest income and the dividend income. But here, what we have studied, we are going to study the royalty income and the FTS income. Okay, so the royalty and FTS are also taxed in the section 115A, because what is the heading? Heading also includes the royalty and the FTS under section 115A. So to make it more simpler, because the royalty and FTS are taxed under two sections, so just to make it clear when this section will apply and when the other section will apply, I have made this in a chart. So in the last session as well, I have talked about the PE. PE is a permanent establishment. Suppose like a permanent branch office or any office that you have established in India is known as the permanent establishment. Okay, now the main factor of determining whether what section will be applicable is the PE. Okay, if the PE, the permanent branch office or any office in India is available, then the 44DA will applicable, the section 44DA will be applicable. And when the permanent establishment is not available in India, then section 115A shall applicable, and in that case the tax at the rate of 20% will be applicable. And again, everything will remain same. On gross royalty or FTS, the approved by central government, no deduction on the respect of PGBP or IFOS. Deduction under chapter 6A shall be permissible. Here the deduction under chapter 6A will be permissible. Above, under section 115A for the royalty and the dividend income, the deduction under section under chapter 6A was not available. Okay, na? Here the exemption from filing of return is under section 139(1) as well. Tax has been deducted at the rate of 20%. We all know the same provisions as we already studied on the above page, that if you are earning the same only this type of income, and you have paid the tax deduct if you have paid the TDS on that income as well at the respective rate, so you are not liable to file the income tax return. Suppose now it is a non-resident, so non-resident can also say I can apply a DTAA, and the DTAA rate says it is taxable at the rate of 10%. Now you are saying the 20%. So in the first class of the DTAA, I said whichever is more beneficial to the assessee, you have to claim. So the assessee claimed the 10% rate of taxation. So if the government says, if you opting for the tax rate which is less than 20%, then the exemption from filing of return shall not be available to you. So what government is saying, if the tax has been deducted at the rate lower than 20% by availing the beneficial provisions of the DTAA, then no exemption would be available from filing of return of income. Then you have to file return of income to the government of India. This is section 115A for the royalty and the FTS when there is no PE exist in India. But suppose when PE exists in India, now the government said when there is a PE in India, so we assume it is an Indian company. When it is an Indian company, so every provision as Indian company applies, every provision shall apply on these type of companies as well. So the accounts and audit shall be applicable. Books of account shall be maintained under section 44AA, and the audit of these books of account shall also happen 1 month prior to the due date of filing of return as usual. This is the only date. Okay, now deduction of expenditure, what it says, no type of deduction will be available if you are not incurred that deduction, if you are not incurred that expenditure wholly and exclusively for your PE. If you have incurred any expenditure which is not incurred for the PE, which you have expended for any other company, any other subsidiary or any other branch, not for PE, then no deduction will be available. The deduction will only be available when the expenditure is incurred wholly or exclusively for the PE in India. So the government said that no deduction in respect of expenses not incurred wholly and exclusively in relation to PE, fixed place of profession in India. Is this clear? Now only the reimbursement to the head office is allowed. Any other type of deduction will not be allowed. Only what will allow the reimbursement to the expenditure done by the HO on your behalf. Suppose I am a PE. I said to my HO that I am in need of money. So please, can you buy me a plant and machinery of 100 CR? I will pay you when I'll get the money. Okay, when my financial crunch will be fine, I'll give you the 100 crore rupees. So the HO has purchased the plant and machinery for me and sent it back to the India of 100 crore rupees. Now after 2 years, I have sufficient money, and I have the surplus of 100 crore. I just transferred the expenses. I just reimbursed the expenses made by the HO of 100 crore. This type of reimbursement is allowed. This is also the expenditure. This is allowed by the government. Government said no deduction in respect of amount paid other than reimbursement of actual expenses by PE, fixed place of business, to HO and other offices. Is this point clear? This is the whole point. Now we are coming to 115 AC and 115 AD. Is this point clear to you all or not? Please let me know. Till then, I just drink a few drop of waters. Till then, please let me know. Share PDF, sir, above class. The PDF of non-resident taxation is already being shared in my Telegram channel. The link of the Telegram channel is available in the description box. You can join from there as well. Okay, the link is on the notes are already being shared in that channel. Okay. Now coming forward to the section 115 AC and 115 AD. Okay. Now 115 AC is applicable to a non-resident, including the foreign company, means every non-resident. Okay, applicable on bonds of Indian company or GDR acquired in foreign currency. It will be applicable on the bonds and the GDR acquired in the foreign currency. Okay, I acquired in the foreign currency, the Indian acquired in the foreign currency. Is this okay? Now what? Now the NR, which gave us the fund for the bond or the GDR, will get the interest, will get the dividend, will get the capital gain as well if they transfer those bonds or the GDRs. So in that case, the applicable tax rate will be 10% in all the three cases for the long term capital gain as well, dividend as well, and the interest as well. And the TDS section will be 196C. The TDS will be deducted at the rate of same 10% which are specified above. So this is whole 115 AC. 115 AC just covered the bond and the GDR. If they are, if any of the company in India, if in foreign currency purchase, just issue the bonds or the GDR in the foreign company or the non-resident subscribe to those bonds and GDR, and they are getting the interest income, dividend income, or maybe the capital gain income in terms when they transfer those bonds or the GDR, they will be taxed at the rate of 10%. Okay, now for this you need to refer some important points as well. These are the same points which you have already studied. See, no deduction under PGBP or IFOS will be available. Set off will be available. No need of return of filing of income if the total income consists only dividend or interest income as referred to in this section, and the TDS has been deducted. The same points which you have already studied for the section 115A, the same are repeating. If non-resident transferred security of 115 AC to another non-resident outside India, then no capital gain tax implication will arise. Means if the non-resident outside India transferred to another non-resident outside India, my GDR, I issued a GDR to a non-resident. Okay, now they have transferred the my bond. The non-resident has transferred my bond to another non-resident outside India. So in that scenario, the India will not be affected. So there is no type of tax. The income will not accrue or arise in India. So there will be no tax implication in this case. So no capital gain tax will arise. Okay, now suppose when suppose some person, suppose Sudhakar has invested in some company and he is enjoying the benefit of 115 AC. Is this clear? Now that company either amalgamated or demerged into any other company. Can the Sudhakar take the benefit of section 115 AC in the new company, in the resulting company, or the amalgamated company? Can Sudhakar carry forward their benefit of 115 AC to the amalgamated or the resulting company? The government said yes, he can carry forward his benefit as well. So, in case of the amalgamation or demerger, benefit continued in respect of the bond or GDR of amalgamated or resulting company. Is this point clear? Now coming to the point of 115 AD. What 115 AD says, that it is applicable to the FII or the specified fund or the FIIs. And what are the type of securities covered? Any type of securities. But what it excludes? Other than units of UTI and the mutual funds. Okay, why it is excluded? Because it is covered under section 169, 196A of 115A. I have also focused here as well. Here the word what is written? Income is written. Income includes any type of income. So here every type, capital gain, interest, dividend, every type of income will be covered here. I just also highlighted this point while I was talking about the non-resident unit holder under section 115A. That's why every type of capital gain or the interest, dividend, income of the mutual fund is already covered under section 115A. So the section 115A shall not be applicable on those type of incomes. Okay, so this is a general section. This is a general section which talks about every type of securities. But see, 115 AC is a specific section which talks about bonds of Indian company or GDR acquired in foreign currency. Is this clear? It is a specific section or it is a general section. So always remember, specific section override the general section. Okay. So first we will see the 115 AC, whether the securities are covered under section 115 AC. If they are covered, so apply 115 AC. If the securities are not covered under section 115 AC or 115 A, then come to the section 115 AD. So you can say it is a residual section. Okay, it is a residual section. Now the interest and the dividend will be taxable for the FIS 20% and for a specified fund 10%. Now just read the tax rate for the capital gains. LTCG tax at the rate of 10%, same here as well. LTCG under section 112A, you all know, is already tax at the rate of 10% under section 112A. STCG 111A 15%, the same applicable rate. STCG at the rate of 30% is taxable. Okay. Now the TDS shall be deducted under section 196D only on interest or the dividend income. Okay. Only on the interest or the dividend income, not the capital gains here. Is this clear? Clear. Now coming on to the point. See, here what we have studied, here we have studied the specified fund. A specified fund may have various type of investors in it. It may also have a resident investor, it may also have a non-resident investor. So we want to give the benefit to the non-resident investor so that we can only apply the 10% or 15% rate. So we need to find the proportion of the non-resident in the total specified fund. So there is a formula of finding the proportion. This is the normal formula which you always apply to find the proportion. What is the formula? Just keep the aggregate of daily AUMs. AUMs is asset under management held by NR unit holder from the date of acquisition to the date of transfer of capital asset divided by aggregate of daily AUM of specified fund. So it is of NR, it is of total. So you will find the proportion of NR, just multiply it by the capital gain. You will find the capital gain attributable to the NR. Suppose it comes to 50 CR. Okay. Now, same For the income as well, it is for the capital gain. Now same for the income as well. The asset under management held by NR unit holder as on the date of receipt of income divided by asset under management of a specified fund as on the date of receipt of income. Here also comes the proportion of the interest income. Interest income comes to 10 CR. Is this clear? So total this 50%, 50 crore rupees on the capital gain. The 50 crore rupees capital gain will be taxable at the rate of 10% here. It will be taxable at the rate of 10%. And the interest income, the income or the dividend of the specified fund will also be taxed at the rate of 10% here. Okay, this is the case that we have to understand. This is the formula that we need to remember, but this will not be asked in the examination, so you do not need to worry about it. It will not be asked in your examinations. This is just given in your study material, so I just let you know this is the provision exists in your syllabus. Okay, done. So for the 115 AD as well, there is some provision. No deduction under the chapter as PGBP and IFOS under section 80 C to 80U. No deduction shall be available. So the deduction will not be available for the PGBP, IFOS, and the chapter 6A. Set of provision shall apply. Income of a specified fund as attributable to the units by NR, which we have calculated just above. Here we have calculated the income attributable to the NR. Okay, except P of NR India in India will only be covered under this section. Only the interest attributable that we have already calculated the 50% of the 10 crore, 50 crore or the 10 crores. Okay, if the specified fund in investment division of an offshore banking unit, the provision of this section shall apply to the extent of the income is attributable to the investment division or the investment income. What type of income? These are the interest or the dividend income of such banking units. In case of applicability of 115 AC, you can now relate this point that the in case of applicability of 115 AC, that a special section shall prevail over the provisions of this section 115 AD. I just mentioned it above here as well, that the specific section shall always prevail above the general section. So it is also given in the point that in case of applicability of section 115 AC, that a special section shall prevail over the provisions of this section 115 AD. Is this point clear? We have completed the majority part of this chapter. Just few points are left. After that we will wind up the today's part of non-resident taxation. The concept of non-resident taxation will be covered in three parts. Okay, this part will be end up by today's session. Major part will be end up by today's sessions. Like in the second section, there are some type of exemptions need to be understand. After that, the residential status of the company or the other type of persons which are available, and some the royalty income and the definition of royalty income and some case laws need to be understand. Okay, now presumptive taxation. As in the PGBP chapter, you have studied the 44AD, 44ADA, 44EAE. These are the presumptive taxation. So here as well for the non-resident, the government issued the presumptive taxation sections. These are 44A, 44B, 44BB, 44BB, 44BBA, 44BB, and 44BBB. See, under section 44B, covered is shipping business. Any non-resident engaged in shipping business. Any non-resident engaged in the shipping business will cover under section 44B. The tax will be the income. What will be the presumptive income? Presumptive income shall be the 7.5% of the specified sum. Now, what is the specified sum? A specified sum is the sum total of when uh, the ship is going from India, just total that the amount of the ship, and when the ship is coming back to India, total that amount of the ship. So the total of these two transactions will be the specified sum of that 7.5% will be your income. So amount paid or payable on carriage of passenger, livestock, mail, goods shipped at or from any port in India. It is going from India, and the amount received or deemed to be received in India on account of carriage of passenger, livestock, mail, or goods shipped at or from or from any port or place outside India, so that they have docked from any other, they are coming to India to dock. So when they are coming from to India to dock, so they are using the Indian port, so the income will arise in India as well. Okay, so we have to sum total it, and by after sum totaling it, apply the 7.5% of specified income. Is this clear? This will be the this will be your presumptive income. Now apply 40% on this 7.5%. This will be your tax rate. Okay, now whether here the provision, whether the section 44B and the 44BB, just complete first the 44BBA. Here the shipping business. Now here comes the aircraft business as well. Here the under section 44B, the shipping business, the companies which are engaged in the shipping business are covered. Under section 44BBA, the companies engaged in the aircraft business is covered. Here also the non-resident covered. Here the 5% of the specified sum. Specified sum is similar. See, for both the similar definition is given. Now for both, can we opt the lower income? Can we opt the lower income from 7.5 and the 5%? The option which is available in section 44AD or 44ADA in the PGBP, whether the similar provision exists here as well, the government said no. For 44B in the 44BBA, the similar provisions do not exist, not available. You cannot declare in your income lower than the specified rates. Is this clear? Now coming to the last two portions, that of the presumptive taxation, 44BB and the 44BB. Now here my company, what are assessed company doing? Assessee company is a non-resident. They are providing services. Providing services to whom? Providing services to the company who are in the business of extracting or production of minerals oil, who are in the process of extracting or production of mineral oil. What I am doing, I am providing the services or supplying the plant and machinery to those type of income, those type of companies. So the I will my presumptive income will be the 10% on the specified sum. What is the specified sum? The same specified sum shall be available here, just the wordings are here and there because the section here changes. Is this point clear? Now, business of civils. Now here what my companies do, here I was under section 44BB, what I am providing, I was providing the service to the company who is in the business of extraction or production of the mineral oil. Now under section 4BB, my company is providing the civil construction or the construction for the erection of the plant and machinery in the business. What type of business? The business for the turnkey project approved by the central government. If there is a company which is doing the turnkey project business, and I am providing the civil construction of for erection of plant and machinery in those service in those businesses, then I will be covered under section 44 triple B. On that, either from that only the foreign companies are SSEs, not only the non-resident. Here, non-resident can include the individuals as well. But here, what is written? Foreign companies. So no individual can become a assessee in this section. Oh, this section will only be applicable for the foreign company. Now, the 10% of the specified sum shall be the rate of presumptive taxation. Now, the amount paid or payable on account of civil construction or erection or testing of commissioning, the same amount shall be the specified sum, and you have to apply the 10% of it. Okay, now coming to the common points of 44BB and the 44 triple BA. Triple B and the 44BB. Okay, here the lower profits can be claimed. For that, you have to maintain the books of accounts and do the audit as per the normal provisions. So the lower profit may be claimed under section 44BB and the 44BBB, provided the assessee maintains the books of accounts under section 44AA and gets them audited under section 44AB. No profit, no set of unabsorbed depreciation or brought forward would be allowed to the assessee in the previous year in which he or it declares profit or gains at the rate of 10% in accordance with the presumptive provisions of 44BB and the 44BBB. What it says no set of unabsorbed losses, unabsorbed depreciation or the brought forward losses will not be available if the person or if the company, foreign company, is opting for the presumptive taxation under section 44B and the 44BBB. 44BB and the 44BBB. there is no provision for giving the unabsorbed depreciation, the set off of unabsorbed depreciation or the brought forward loss. These will not be available to you. This is the amendment for your attempt. The green portion is amendment for your attempt. Okay. Now what say it says 44B versus 172. As I already said, the 7.5% will be taxed at the rate of 40%. This says it says the same. Here you change, it is a PGBP, entire PGBP. Okay, section 172 overrides the entire PGBP. Above charges will include the demurrage and handling charges. All are the incidental charges will be included thereon. Okay, it overrides above PGBP's only PGBP section, and therefore, as per section 44B, unabsorbed depreciation shall not be allowed, but brought forward losses shall, and section chapter 6 shall be allowed. Okay, because it only overrides section, only override the PGP section. So it will not allow the unabsorbed depreciation, but will allow the set off and carry forward of losses as well. So the assessee is supposed to pay the rate of 40% on 7.5%, which I have already mentioned here. Okay, the company needs to give because it is a foreign company, so you have to give at the rate tax at the rate of 7.5% on the you have to give tax at the rate of 40% on the income of 7.5% plus applicable surcharge to 5% plus the health and education cess. Now, as per the Supreme Court, what Supreme Court says? Supreme Court says that any tax paid under Section 172 shall be deemed to be the advance tax, and if any refund is available by applying the other section of this Act, if there is any refund is available, so we will issue the refund as well with interest. The Supreme Court, under the ruling of AS Glitter, says that the tax paid under Section 172 shall be considered as the advance tax, and any refund of such amount shall be entitled for interest. Is this point clear? Now coming on to the point of non-resident sportsman or sports association under Section 115 BBA. Applicability, income covered, tax rates, and the additional provisions. This is the set format in which we are going forward. Okay. Now, see, NR non-Indian citizen and the sportsman. Here what it says, a sportsman. So the referee or the umpires will not come here. It comes the hardcore sportsman, sportsperson. This is also confirmed by a ruling in the case of Indicom versus CIT TDS by the Calcutta High Court. What Calcutta High Court says, the umpire and the match referees can be described as a professional or technical person who render professional or technical services, but they cannot be said to be either non-resident sportsperson or sports association so as to attract the provision of section 115 BBA. They will not be covered under section 115 BBA, and consequently the provision of TDS shall not be available under section 194E are also not attracted in this case. Okay, for the section 115 BBA, the TDS is deducted under section 194E, whose reference is given here. Is this point clear? Clear. So, any non-resident sports person comes in India and earning by way of participation in any game, suppose IPL, the Australian players, South African players, they come in India and they play. So they get so they participate in India in the IPLs. Okay. Or they contribute to articles in India, or they do any advertisement like the Dream 11 advertisement, they do the Coca-Cola, Pepsi advertisement, they do. So any type of income earning by these three types of modes, so the tax rate will be 20%. Or suppose any non-resident sports association, say to the Pakistan Cricket Board, the BCCI said, you send your players in India IPL, we will give you the guarantee money of this amount will be the guarantee money. Suppose the 10 crore we will give definitely to you, this I am guaranteeing to you, you just send your players in India to play the IPL. If any type of organization, the sports organization commit that guarantee money to any other sports organization, so that guarantee money will also be taxed at the rate of 20%. Now, for a non-resident, non-Indian citizen entertainer, you may have noticed in the recent case of Anant Ambani's wedding. In the Anant Ambani's wedding, there are various non-resident entertainers, non-Indian entertainers, non-Indian citizen entertainers came into the Geo Convention Center in Mumbai and performed various things like dancing, singing, and the instrumental as well. They perform various things. So if they are earning from that, so they from the performance in India, so they will also be taxed at the rate of 20%. Now again the same provisions, no deduction of any provision. Here it says any provision. Forgot about PGBP, forgot about IFOS. We said any provision. PGBP, IFOS, salary, capital gain, other sources, every provision, house property, any provision will not be available here. Chapter 6 say either everything needs to be foregone. Every set of carry forward, everything needs to be foregone here. No need to file ITR if the total income includes this type of income only and the TDS under section 194 has been deducted. This is the similar point that we are used to study from since when we have started our session. Is this clear? Just we have to study till now, till here as here only. Just only 2 pages are left. Is this clear? Can you just let me know once? Is everything clear? Please interact in the chat box, live chat, so that I can get a fair idea whether you are understanding everything or not. Okay. Now just correct it. It's 115I, not 115J. Okay. Now coming to a taxation of the non-resident individual. First, I am saying it is a optional scheme. It is a optional scheme. Okay. If the non-resident individual want to opt this scheme, so it can opt, he can opt. But if they do not want to opt this scheme, they can pay the tax as per the normal provisions of the act. Okay. Now, the foreign exchange assets. What are the foreign exchange assets? Foreign exchange assets are the shares of the private or listed company or the debentures of the private company, sorry, public company only, deposits of the public company only, and the securities of the government companies, the central government purchased in foreign currency. Okay, so these are the foreign exchange assets. If any NRI purchase these types of asset, okay, now they are earning income. Investment income means interest or dividend income. So it will be taxed at the rate of 20%. STCG will be taxed at the rate of 10%. Other income will be taxed at the rate of normal tax rate. Okay, now what is non-resident individuals is NR plus Indian citizen or the person of Indian origin. It is the Indian citizen or the person of Indian origin, but it is the non-resident for this year. So it becomes the NRI, non-resident individuals, non-resident Indians. Okay, it is NRI. Okay, so here the indexation provision shall not also be available. No deduction or allowance of any provisions of this act. Again, any provisions of this act shall be available while computing the investment income. Here it wrote the investment income means not the capital income. For the capital income, you will get some deduction. You can take some deductions. Okay. Benefit can be continued even after become the resident in the filing of by filing a declaration in the return of income. Suppose if you are a non-resident Indian and opting the benefit under this chapter, but by suppose by virtue of the COVID you stuck in India and become the resident. So in that circumstance, the government said if you are a non-resident Indian, but due to some circumstances you have stuck to in India, and by virtue of that you become the resident in India. So now you have to file the return of income as per the normal provisions. So you can file a declaration with that, and in these cases, in these type of exceptional cases, we will allow the benefit to be continued in the year of when you become the resident. Okay, this provision helped the COVID individuals who is stuck in India. Okay, now if total income consists only in investment income in the LTCG and TDS has been deducted, then then no ROI. This point is also similar. Now, if the non-resident individual has transferred these type of assets, okay, and purchased the another forex asset or the saving certificate, within 6 months of transfer, within 6 months of transfer, so the government will allow the exemption of the net consideration. What will be the exemption of the net consideration? Exempt amount will be equal to the long term capital gain multiplied by the cost of new asset divided by the net consideration. This will be the amount of the exempt income. Now the government said, if you are purchasing this, if you are taking this exemption, so make sure you do not sell those newly bought asset for the for 3 years. If you transfer the newly buy assets within the period of 3 years, then there will be the violation of this provision, and we will tax the exempt amount which we have exempt here. We will tax the whole amount in the year when you violated the provision. Okay, so these provisions are said capital gain will be exempt if the net consideration is utilized for acquiring other forex asset or saving certificate within 6 months from the transfer date of transfer. Note, lock-in period is 3 years, and if any violation, then earlier allowed exemption like this will be withdrawn prospectively. Okay, now you know LTCG. LTCG are of two type, 112 and the 112A. And for 112A, there is an exemption limit of 1 lakh. For 1 lakh, there will be no tax. And above 1 lakh, there will be a tax of the rate of 10%. So the government is saying the exemption of 1 lakh shall also not be available under this section, under this chapter. The exemption of 1 lakh rupees not available on the capital gain under section 112A. Is this point clear? Clear. Now coming on to just holding it on. Now coming on to the first 115JG. Suppose there is a foreign bank, HSBC, which have an Indian branch. Now they want to convert their Indian branch to a Indian subsidiary. So whether this type of conversion will attract the capital gain, because it is a transfer of a branch to a Indian subsidiary. The government said no. We will not assume this will be a capital. We will not attract the capital gain if the certain conditions is fulfilled. What are those conditions? The government said first condition is the this arrangement, this conversion should be based on the RBI guidelines. These are the conversions which should be done based on the RBI guidelines. So see what it says: when a foreign company or the foreign bank engaged in the business of banking, like the HBFC, HSBC, is its Indian branch into the subsidiary company gets capital gain on conversion would not be taxable if this conversion, if you say the Indian branch amalgamates with Indian subsidiary as per the scheme of amalgamation by shareholders or the or the foreign company and the Indian subsidiary and sanctioned by RBI. The point which you need to understand, it should be sanctioned by the RBI. Okay. Now all asset and liabilities need to be transferred. Every asset and liability need to be transferred at the book value. When I said book value, whether the revaluation shall be allowed? No, revaluation shall not be allowed in any circumstance. So you have to transfer all type of assets and liability. Assets and liability are transferred at the book values, and no revaluation would be considered in this type. Is this point clear? Now when you are transferring, when you are converting Indian branch to a foreign Indian subsidiary, so for the Indian subsidiary you will get some shares, you will get shares. So what you will so you will not get any type of a monetary benefit other than the shares. The foreign bank should not get any other type of monetary benefit other, except the shares of the Indian subsidiary. Is this clear? Foreign bank or nominees should hold 100% of the share capital of Indian subsidiary till the end of the year of conversion, and at least 51% of the voting power of Indian subsidiary for the next 5 years. So for the year of conversion you have to hold 100%, and for the next subsequent 5 years the voting power should be in 51% in the hands of the foreign bank. Okay, then Foreign company does not receive any consideration or benefit other than by way of allotment of shares in the Indian subsidiary. That had made you clear. Now, unabsorbed depreciation set of carry forward of losses met credit related to the branch shall be allowed to the Indian subsidiary company as if no conversion takes place. Any benefit, see what it says, any benefit exemption available to the Indian branch shall be same carry forward to the Indian subsidiary as if no conversion takes place. Is this point clear? Now, suppose if there is any violation of the condition, if there is any violation of the condition and the government gets to know the violation before claiming the benefits, before you claiming the benefit, government got to know that you have violated some of the conditions of this section. So the government said at the time of claiming of the benefit, if we get to know that you have violated any of the conditions, so we will not go, we are not going to give you any type of deductions. No benefit shall be allowed. Computation and taxation of foreign company and Indian subsidiary company will be done normally. You will be taxed no at the normal rate of taxation. Okay, there will be no type of deduction will be available. But suppose the government get to know after we have claimed the benefits. So here the government keeps the power of rectification and gives the power to the AO that he can rectify that mistake. He can recompute the income under section 154, and the period which is given to that to the AO is 4 years from the of the rectification shall be considered from the end of the previous year in which such condition is violated, the end of the 4 years. Suppose if we have violated the condition in 23-24, so end of the previous year 31st March 24, so the AO has the power to rectify it by 31st March 28. Okay, what it says, see, benefit shall be deemed to have been wrongly availed. The AO is empowered to recompute the total income of the assessee by way of rectification under section 154. The period of 4 years of rectification shall be considered from the end of the previous year in which such condition is violated. Is this point clear? Now, coming on to the second last topic of today, 115JH. What it says? It says, suppose a company is a non-resident company, but by virtue of a poem that we are going to study day after tomorrow, by virtue of poem, the company become resident for the first time in India. For the first time in India. So whether all the provisions of income tax shall apply to those type of non-resident companies, they do not know the income tax. So the government feels the pain of those non-resident companies and said the whole provisions of the income tax shall not be available. We will give you the benefit exemptions as available to you, the relief as available to you in certain respect. When you become the first time resident because of the poem. Okay, what it says, if a foreign company has never been the resident in India, becomes resident in India in the relevant previous year for the first time due to the poem in India, then or the said previous year benefit exemption relief as may be specified in the notification of the central government subject to the specified conditions therein. These are the conditions will be allowed in the in relation to the following. What is the in which sections we are going to allow the benefit and the exemptions and relief? The computation of total income, treatment of unabsorbed depreciation, set off and carry forward as losses or the set off of losses, collection and recovery is the TDS, and the special provision related to the avoidance of tax is the transfer pricing provisions. Okay, now suppose for the previous year 23-24, I filed the return of income as a non-resident. I do not know I have become the resident because of the poem. The company did not know. Company filed the return of income and the AO opened the scrutiny of the company. Is this clear? Now, when the AO opened the scrutiny of the company, he finds that the company becomes a resident in the in the previous year 23-24, and not only in the previous year 23-24, he also find for the previous year 2021 he become the resident. So For the 23-24, we know all these type of benefits shall be available, whether the section 115JH, all these type of exemption, the benefit shall be available for this year as well. This is the question. So the government clarified that this shall be available as well for this, for the year 2021 as well. The provision shall be the provision of section 115JH shall be available. So what it says, see, if poem of a foreign company or for any previous year has been determined in the assessment proceedings, then in addition of such previous year like 23 24, any other previous year which ends on or before such assessment completion date, on or before this is previous year 2021, aforesaid benefit exemption relief will be allowed. Okay, if benefit of this session has been allowed and subsequently there is a violation of notified condition, now if we have allowed and you have violated any of the said conditions, so what we have studied here under section 115 JG, all these points, the before and after claiming the exemption, these points will be applicable in the section 115 JH as well. The company said then the provision relating to the withdrawal of benefit as discussed under section 105 JG shall also apply here. Is this point clear? Now coming to the last portion. Section 195. What section 195 says? Section 195 says if any income is not specified in any section for the non-resident, that it should get taxed at such or such rate. If any income or the any interest or any tax rate is not specified in any other section of the income tax act for the non-resident, then section 195 provides the residual entry and said that section 195 shall be applied in all these cases where no income, no specified section is available for those type of income. So the residual case under section 195 come into play and say where if any person pays the non-resident or the foreign company any sum which is not chargeable under any other section of this chapter shall be taxed at the rate in force, shall be taxed at the rate in force under section 195. What it says, TDS only if such sum is taxable in India. The TDS shall apply only when such income is taxable in India. When this income is not taxable in India, then the provision of TDS will not come into play. So this is the normal point. This is the basic point that we need, that we all know. Okay. Now coming on to the next point. Payment to overseas agent for services rendered outside India is not taxable in India. When there is a services rendered to a offshore, when we have rendered the services to the offshore agents and for that services, a non-resident has made some payment to the overseas agent for services rendered outside India. In both the cases, the non-resident are covered, the India is not covered. So the income is not accrued or arise in India. So the provision for TDS shall not also apply here. Now, interest paid by firm to a non-resident partner, here the TDS shall be taxable at the rate in force under section 195. Okay. Now, any person who is responsible for paying any sum to a non-resident, he will definitely let know the government by furnishing the information of such payment to the non-resident. Here is the responsibility of the person paying the any sum to the non-resident. Person paying any sum to a non-resident to or the foreign company shall require to furnish the information related to such sum. Is this clear? Section 195 is also clear. Today we have completed today's target. Today's target complete. We will continue from tomorrow here, from here, and we will go till end. Tomorrow we will end till here. Okay? And day after tomorrow, we will complete the rest portion of this chapter. Okay? Rest portion is the residential status portion. The residential status of the company and all. We will complete uh, till here, day after tomorrow. Is this clear? This class is clear to you all or not? Please let me know whether there is any doubt or doubt, so you can ask me. Otherwise, we'll wind up the class for today. If you have any doubt, please let me know. I will resolve the doubt as but you need to let me know if you have any doubts. I will try to resolve the doubts as possible for me. Thank you so much, Kalai, for watching the lecture. I hope you understood the whole provision of the non-resident taxation. If you have any other doubts, so you can also ask. Otherwise, we'll the wind up the session for today. I'm just waiting for a 2 or 3 minutes. If you have any doubts or any feedbacks, so you can let me know. We are not going to study something new today. So if you have no doubt, so you can leave and study your another subject which you want to study. For today, we are not going to study anything new in this chapter. So if you have no doubts, you can leave the session. Um, Take care for that, and we'll meet tomorrow at the same time. I think everything is clear to you, everyone. So let's wind up the session for today. If you have any doubt, so you can ask me in the chat, in the either in the comment section or in the Telegram group or the channel. I will be available there as well. So let's meet tomorrow at the same time, 8 p.m. We will complete the rest portion of the non-resident taxation, the provisional aspects. Then we will understand the residential status in the next day or the day after tomorrow. So till then, take care. Have a good studies. All the best for your examinations. Do study hard. Till then, let's meet tomorrow. Bye.